If you own a holiday home overseas, understanding UK capital gains tax and double taxation rules could help you avoid costly reporting mistakes.
Imagine selling a holiday villa in France for the exact euro amount you paid for it. You didn't make a profit, so you assume you broke even. But then, weeks later, a brown envelope arrives from HMRC demanding thousands of pounds in capital gains tax. I'm a senior tax expert from Pro Tax Accountant. Today, we are breaking down the capital gains tax rules for UK residents selling overseas holiday homes and how to avoid being taxed twice on the same transaction. To understand how this happens, we have to start with the baseline rule of the UK tax system. If you are a UK tax resident, HMRC taxes you on your worldwide income and gains. It does not matter where the asset is physically located. For the 2025-2026 tax year, the UK charges a capital gains tax of 18% for basic rate taxpayers and 24% for higher rate taxpayers on residential property sales, and your tax-free allowance is strictly capped at just £3,000. Many property owners assume that if they pay property tax to the local foreign government, they are completely exempt from UK liability. That is the single most expensive assumption an overseas property owner can make. Let's dismantle the exemption myth. Say you sell a house on the Spanish coast. You pay the Spanish tax office, and naturally you assume your tax obligations are finished. International tax law operates on double taxation agreements. These agreements allocate primary taxing rights to the source country, Spain in this scenario. However, the UK retains secondary taxing rights over that exact same profit. To prevent paying full tax in both countries, the law relies on foreign tax credit relief. You have a 19% Spanish tax bucket and a 24% UK bucket. The 19% tax paid in Spain is legally offset against your UK bill, filling the UK bucket. Double taxation is successfully avoided. You don't pay 43% total. But because the UK higher rate is 24%, a 5% residual top-up payment will almost always remain due to HMRC. That brings us to the currency myth, the belief that if an asset doesn't appreciate in its local currency, there is no taxable gain. This was settled in a 1981 High Court case, Bentley v. Pike. The court established a strict statutory principle. When calculating foreign capital gains, all figures must be converted into sterling. Look at this timeline. You lock in the acquisition cost at the exact exchange rate when purchased, then convert proceeds using the rate when you sell. If the pound depreciated, you could sell at a loss in Europe, but register a massive profit in sterling. Currency fluctuation manufactures an invisible UK tax risk. It operates entirely independently of your property's actual market performance abroad. Even if you handle the currency math perfectly, local post-Brexit nuances can destroy your tax credit claims. France is the perfect example. By default, France levies an 18.6% social charge on property gains. But if you are a UK resident affiliated with the British Social Security system, you qualify for a reduced 7.5% solidarity levy. You have to actively prove your status to the French authorities to get this rate. If you fail to claim that reduction and simply pay the standard 18.6%, HMRC categorizes the overpaid French tax as inadmissible. They will refuse to credit it against your UK bill, resulting in inescapable pound-for-pound double taxation. Finally, we have the deadline myth. Taxpayers frequently panic, believing they only have 60 days to report an overseas sale to HMRC. The strict 60-day reporting and payment requirement is explicitly restricted to the disposal of UK residential property. It does not apply to your overseas properties. For an overseas disposal, you declare the transaction via the foreign pages, Schedule SA-106, of your annual self-assessment tax return. Any tax due is payable by January 31st following the end of the relevant tax year. This extended timeline is highly strategic. It provides property owners the vital window necessary to source their foreign tax documentation and correctly calculate complex tax credit limits before ever paying HMRC. HMRC always taxes worldwide gains, exchange rates can manufacture artificial profits, and claiming foreign tax credit relief requires precise mathematical execution. Please note, this video provides general information based on 2025-2026 legislation and does not constitute formal tax advice. To navigate these double tax treaties and avoid costly mistakes, contact our team at Pro Tax Accountant. Securing expert accounting representation is the only reliable way to protect the wealth generated from your overseas property sale from punitive double taxation.